Hey there, fabulous financiers. Welcome back to another episode of the Do.Different.Better Show, where we talk about wealth wisdom and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connective Institute, and managing director of the Integrated Capital Fund. Thank you for joining me today. Today, we're going to be sinking our teeth into a topic that could help you keep more of your hard-earned money where it belongs, in your pocket. We're talking about tax efficient investing. And trust me, this is one area where a little knowledge can go a long way in boosting your returns. So buckle up, because by the end of this episode, you'll be ready to invest smarter and pay Uncle Sam just a little bit less. Okay. All right, let's kick things off with an overview of today's theme: how to invest smartly to minimize taxes. Now, why does that even matter? Well, whether you're an individual investor or a small business owner, reducing your tax burden can significantly boost your overall returns. I mean, who wouldn't want to keep more of their own money, right? But here's why it matters. Let's say you're earning a decent return on your investments, but every year a big chunk of that return goes straight to taxes. Ooh. By being mindful of tax efficient strategies, you could potentially increase your investment returns up by 1 to 2% annually. Now, I know that may not sound like a lot. You're like, Elaine, 1 to 2%, is that it? But here's a fun fact. Over time, that 1% can add up to tens of thousands of dollars or more, especially when you're reinvesting these savings and letting them compound. So, yeah, it matters over time. But let's take a step back and let's understand the basics. Let's break it down what tax efficient investing actually means. Simply put, it's an investing in a way that minimizes the amount of taxes you pay on returns. The less taxes you pay, the more you get to keep and invest back into your business, back into other opportunities. This is what many business people do. So if it feels like, this feels like illegal to know, Elaine, it is not. Everything I'm going to share with you is street legal, right? But I definitely encourage you to bring your accountant into this conversation. I am not a tax professional, so definitely talk to your tax professional, a CPA, your accountant, and really looking at your portfolio, or even if you haven't started investing yet, what are some of the things, what are the opportunities that are available to you, not only for your particular tax bracket, but also for your particular goals. Remember, we talked about connecting with a financial planner, a certified financial planner. Between your accountant and your certified financial planner, they are going to help you navigate some of the things that I'm talking about today. So you can bring this conversation to them and they can tell you what are some of the best levers to leverage for your situation. And everybody's situation is completely different. So first, let's talk about the types of taxes. There are a few main types of taxes that can impact your investments. One is capital gains tax. This is the tax you pay on the profit when you sell an investment for more than what you paid. And that's any investment. It could be real estate, it could be stocks, it could be anything. If you hold an investment for more than a year, you're likely to pay long-term capital gains tax, which is usually lower than short-term capital gains tax for assets held for less than a year. 2, income tax. Any interest you earn on bonds, savings accounts, and certain dividends is typically taxed as ordinary income. The rate you pay depends on your particular tax bracket. 3, dividend tax. Dividends paid out by stocks are taxed differently, differently depending on whether they are qualified or ordinary. Qualified dividends are taxed at a lower long-term capital gains rate, while ordinary dividends are taxed as income. So here are some common mistakes where people often get tripped up. You might, in previous shows, we talked about starting an investment trade account online. And a common mistake can be doing a lot of frequent trading. Trading in and out of stock frequently might seem like a good idea, but every time you sell an asset, you trigger a taxable event. That can lead to a hefty tax bill at the end of the year because of all the gains that you've gotten throughout the whole year, right? Next is not using tax advantage accounts. Many people miss out on using tax advantage accounts like IRAs or 401ks, where you can invest without paying taxes on gains until you draw the money. And if you know that you're not drawing the money for 10, 15 years in the future, that means you're keeping more cash today. Or in the case of Roth IRAs, never paying taxes on gains if you follow the rules. So once again, this is where either your 401k manager, if this is through your work, or your certified financial planner and or your accountant may be helped to give you some specific guidance. Okay. So here are some practical and tactical steps. So action step one, start by organizing your investments. Are they in the right accounts? Take a look at where your investments are being held. If you're holding income generating assets like bonds or dividend paying stocks in a taxable account, you might be paying more in taxes than you need to. Consider shifting those to a tax advantaged account like an IRA or a 401k. I think some of those rules recently changed in the last sort of 6 years or so, where you might be able to take your capital gains and directly invest into a 401k and not pay those taxes at the moment. You take them once you actually withdraw the money, right? So let's say you withdrew the money to buy a house, you withdrew the money to buy another property investment. That then at that moment you would be taxed, and you're usually taxed at a higher rate than if you were to take that money out sometime in the future, right? So action step number two, identify which of your investments are taxable and which are in a tax advantage account, which means sometimes you may take money that you've already paid taxes on, right? So when you think about 401ks, often 401ks are what are called pre-tax money, meaning when you get your paycheck, your 401k distribution is taken out before you've paid taxes. That's why when you withdraw it, the government wants you to pay taxes because you never paid taxes on that money. Your tax bill on your pay stub is reflected on the amount that you were paid less what was put into your 401k. That's another reason why people often say, if you work at a company that offers a 401k, do it. Do it, do it, do it, do it, do it, do it. There are very few reasons, and I can't think of any of why you wouldn't do it unless you are so financially strapped that you need every single dollar. But think of it this way, even if that's your case, you can withdraw from your 401k if you have an emergency. Now, you will be taxed on that money, but if you have an emergency, so think of it as a savings account that you can't even touch, right? Not without a lot of hard work. But that could help you with starting your savings journey, that could help you with starting your investing journey, is by putting that. It used to be that if you were taking the money out to invest in a home, that there were less, you either didn't have to pay taxes at all or you had significantly reduced taxes. But I think that rule has changed. Once again, see a tax professional. They're going to have you the most up-to-date information on all of these things, right? So we talked about action step number one, starting by organizing your investments, understanding which ones are taxed, which ones are not taxed, and at what point in your life will they be taxed? Will they be taxed when you withdraw? Will they be taxed when you retire? When will the tax event be triggered for the IRS to collect? And maybe you won't know what you're looking at when you organize this, but if you organize this information and take it to an accountant or take it to your financial planner, they can give you some insight into what you're looking at and what might be causes for concern based on the goals that you set up for your life with your financial advisor. So step one, organizing your investments. Two, identify which of your investments are taxable and which ones are in tax advantaged accounts, right? So as I mentioned, I've given you your homework, review your current portfolio, including your home, including anything that you may be inheriting from your parents. You might want to create what's a current document, as well as what you project might be in the future. You might be in line, like my son, I know he's going to be in line for not only an inheritance from his paternal grandmother, he will also more than likely have an inheritance from me. So for him to go and have a conversation with a certified financial planner as thinking about, okay, when might these inheritance hit? What might I want to be aware of? What might I want to be thinking about? Right. But trust me, a little bit of organization is going to go a long way of saving you money. But before I go, let's not forget the other types of taxes that might come into play depending on your situation, such as luxury tax on high end items, estate or inheritance taxes that can affect what you pass on to your heirs, and even state versus federal tax implications. Your state might have another set of taxes you might have to pay on any sorts of investment. So you want to be aware of that. And once again, if this is all sounding overwhelming, this is where you want to bring in a professional, right? And I think we talked about joining investments groups. You can learn from other people who may have made the mistakes so that you don't have to, right? But for example, some states don't have income tax, but they have higher property tax or sales tax to make up for it. So it's important to consider the full picture when you're looking at your investment strategy. So that's it for this introduction to tax efficient investing. I hope you're starting to see the importance of being smart about taxes when it comes to your investments. I want you to stay tuned because in the next segment, we're going to dive into some specific strategies that you can use to minimize your tax burden and to minimize your tax burden even further. So don't forget to leave a review. Don't forget to subscribe. And we're going to be talking more about making sure you keep more of your hard-earned money in your pocket. I'll see you on the next segment. Welcome back to the Do.Different.Better Show, where we're breaking down the nitty-gritty of tax-efficient investing. In our last segment, we talked about why it's crucial to minimize your tax burden and how doing so can significantly boost your investment returns. Now we're getting into the good stuff, some specific strategies that you can use to make sure that you are keeping as much as your hard-earned money in your own pocket. Okay, so first off is using tax advantaged accounts. This is one of the most powerful tools in your tax efficient investing toolkit, tax advantaged accounts. These accounts are designed to help you save for the future while minimizing the taxes you pay along the way. So the first one, and we've talked about this in the past, is retirement accounts. So retirement accounts, there's a wide swath of different types of retirement accounts, but they usually fall into three categories: IRAs, 401ks or 403bs, and Roth IRAs. These are some of the best known and most effective ways to invest tax efficiently. So, first, let's talk about 401ks. When you contribute to a traditional 401k, the money is put in tax deferred. I talked about this in the previous segment. That means you don't pay taxes on it until you withdraw it. It comes off of your paycheck before your taxes are applied. So the tax that you pay, whether it's your income tax that you're paying or your state taxes or your federal taxes, your tax, let's say just for an example, you're in the 24% tax bracket and you contribute $10,000 to your 401k. That's $10,000 that's not taxed today, which you could save $2,400 in taxes. Since it grows tax free, you won't pay taxes on the growth until you start withdrawing in retirement. So it's really a win-win. This gives your account an opportunity in your investment in your 401k to grow tax free over the years, right? So I know that can be a kind of a squishy concept to understand. So let's say you put in $10,000. Let's say over time, you actually maybe double that. Let's for the easy math, you doubled it over time to $20,000. You're still not paying taxes on the $20,000 unless you withdraw $20,000. Let's say you withdraw $10,000 instead of the full 20, you're only taxed on the 10. The 20 still stays in there until you decide to take it out, right? So that's how that works. The other one that is not talked about is necessarily our 403bs. These are self-directed 401k plans, for a lack of a better term. And this is usually either a lot of nonprofits have 403bs where They're not necessarily grouped into a large investing pool or fund, but that these are managed on a much more smaller basis, and they're what's called self-directed, meaning that you can inform what goes into those investment portfolios, but they're usually still pooled with other people, or you can have your own individual account. But it works very similar to a 501. I'm sorry, a 401k. Then you have Roth IRAs. So a Roth IRA, I'm a little tongue-tied today. A Roth IRA works a little bit differently. You can contribute with after-tax dollars, but here's the kicker. Your withdrawals in retirement are completely tax-free. Why is that? Because you already paid the taxes on it. So let's go back to your pay stub. Let's just say your pay stub had $5,000 on it, and that's what you were taxed on. Let's say you took $1,000 of that $5,000 and you went and put it into a Roth IRA. Because you already paid taxes on it from your paycheck, once you put it into the account, even if you wanted to take it out, you will not pay any taxes on that money because you already paid taxes on that money, right? So this is a fantastic option if you expect to be in a higher tax bracket in the future, particularly for young people. Maybe you're at a lower tax bracket, but you're getting your master's degree, you're getting a doctoral degree. So the whole idea is that you're going to be making more money. So by putting in this money now, you're protecting yourself from this higher tax bracket because you've already paid taxes on it, right? Because each tax bracket you go up, you're taxed at a higher rate, right? Depending when you get, there's certain ones. When you get to the uber wealthy, they're taxed less, but that's another conversation we won't have today, okay? But here's an example. Imagine you contribute $6,000 a year into a Roth IRA for 20 years. Your investment grows to $250,000 by the time you retire. All of that money will be tax-free. You will not pay any taxes on that money when you get ready to retire, even if that means you decide to retire early. Maybe you're a genius and you retire at 50, right? So you will not pay any taxes on that money because you already paid it. The next one is an HSA or health savings account. This is a lesser known but incredibly powerful tool, the Health Savings Account or HSA. This is like a Swiss Army knife of tax savings. An HSA is a triple tax advantage account, meaning you get tax deductible contributions, you get tax-free growth, and you get tax-free withdrawals for qualified medical expenses. So if you have a high deductible plan, you're eligible for an HSA. And let me tell you something, it's worth considering. So that's once again, if you can afford. Here's an example. Say you contribute $3,600 to your HSA this year. That's $3,600 that lowers your taxable income off of your pay stub, right? Right. So let's say, for conversation's sake, your pay stub is, $8,000, right? And you put $3,600 into your HSA. You're taxed now on the difference between the 3,600 and the 8,000, right? Any interest or dividends or capital gains earned in that account also grow tax-free. And when you withdraw the money to pay for your medical expenses, there are no taxes there either. So this requires you to sort of have an idea of like, what kinds of health considerations might you have? Maybe you know that you are planning to have a child, right? Whether that be you're individually yourself, or you're adopting, or you're a surrogate. If you know that expense is coming up in a certain amount of time, maybe it's 2-3 years, you might want to take money and put it into an HSA. That money is going to grow. It was taken out of your account, which lowered your tax burden today, but now you're going to have this HSA account that you can now use this money for those those medical expenses related to having a child. So hospitalization, sedation, hospital stay, any of those things. But you want to read the fine print of the HSA and find out what exactly is covered, right? There are going to be certain expenses that will be covered, and there'll be certain expenses that don't qualify as medical expenses under that particular plan. So you want to make sure, but definitely max out your HSA contributions every year. Even if you don't need the funds for medical expenses right away, you can let the money grow over time, and you can even use it as an additional retirement account, withdrawing tax-free funds for healthcare in retirement. So all the doctoring that you might have to do, and I will tell you, I have a parent who's retired. There's a lot of doctoring after the age of 65. And so knowing that you have those doctoring expenses because Medicare and Medicaid or other state and federal insurance don't cover. And with the threat of those things going away, you definitely want to make sure you have funds available that are going to be able to cover your medical expenses when you go into retirement, regardless of what age that is. So next is we're going to be talking about investing in tax efficient funds, right? So let's talk about a different strategy to keep your tax bill in check, right? Tax efficient funds. Number one, index funds and ETFs. So we've talked about this in other episodes, but index funds and ETFs are often a more tax efficient way to mitigate your taxes compared to actively managed funds. And here's why. They have a lower turnover. They have lower turnover rates. This means the fund managers are not buying and selling stocks as frequently, which results in fewer taxable events like capital gains and capital gains distribution. So remember we talked about when you sell a stock and you made more money off of that stock than what you paid for it, that is a taxable event. That is now considered income of which you are taxed on. So the whole idea is to take that and put it into some kind of vehicle that so you can defer or delay the taxes on that. So here's an example. If you invest in an index fund that tracks the Standard & Poor's 500, and we've talked about that on a previous episode, the fund is only buying stocks when the composition of the S&P changes. This happens very frequently, which means you'll likely owe less in capital gains taxes every year compared to an actively managed account where the manager is buying and selling maybe on a weekly basis, right? If you're day trading, if you're managing your own account and you're day trading, once again, you're paying for all those gains at some point in time, particularly in that year, because you'll get a statement that says, these are all the gains that you got this year. And Uncle Sam is going to want to know what those are so that Uncle Sam can tax you on it. Here's a tip. If you're investing in a taxable account, consider focusing on index funds or ETF to maximize your capital gains taxes, to minimize your capital gains taxes. They're a great way to diversify your portfolio without the tax headache. So number two, tax managed funds. Tax managed funds are mutual funds specifically designed to minimize taxes. These funds employ strategies like offsetting capital gains with losses, holding on stocks or longer periods of time to benefit from lower long-term capital gains rates and avoiding investments and generate high taxable income. We also talked about in a previous episode about leveraging donor advised funds and some other tools as well. But here's an example of a tax managed fund. A tax managed fund might sell losing investments to generate losses that can offset gains in other parts of the portfolio, reducing your overall tax liability. They're a smart choice if you're in a higher tax bracket and you're looking for ways to be more tax savvy with your investment. I know it sounds crazy, but there is a universe where people are like, hey, I actually need to lose, I need to show some losses because if I don't show some losses, I'm going to have a higher tax bill. But you gain so much, you'd rather pay money on reducing your tax bill than give it over to Uncle Sam, because then it's not money that you can actually leverage and invest for other opportunities. I know it sounds crazy. It's a whole thing. I'm telling you, this is what wealthy people do all the time. Some of you might be listening to this are like, Elaine, that feels really like skeevy. Maybe it is. Maybe if that's how you feel, totally understandable, totally reasonable. I'm just here to give you the information. And if in lowering your tax bill, if you even want to lower your tax bill so that you can take more of your money and put it into a social purpose, leverage it for that, right? If you don't necessarily have to leverage it for your own personal benefit, leverage it for community benefit. By lowering your tax bill and leveraging some of these tools, you can use these tools to be able to invest back into your community, particularly in ways that maybe aren't necessarily supported or that you're not able to support in maybe some of the other ways in your portfolio. So not all is lost. Not all is, the corporate, what is it? titans of evil, right? So these can very much be leveraged for supporting your community, supporting investments in your community. So let's get into some practical, tactical steps and how you can start implementing some of these strategies today. So, action step number one, review your investment options. Are you using tax efficient funds in your taxable accounts? If not, it might be time to reassess and make some changes. Action step number two, consider reallocating your assets to tax advantage accounts where possible. For example, if you have high yield investments in a taxable account, see if you can move them to a tax advantage account like an IRA or 401k instead. Very similar to like an inheritance. If you received an inheritance or maybe you received a bonus, let's say if you're a salesperson, you work on commission, or you work in an organization where if you hit some annual metrics, you get a bonus. You may want to consider you're going to get taxed on that money. But if you divert that money into a tax advantage account, like a 401k, like a 403b, like an IRA, you will not be taxed, or you'll be taxed at a lower rate in that tax year that you received the money. So I know I had a good friend of mine who was a co-investor, and about every February, she got a bonus check of about $20,000 or $30,000. Now, if she were taxed on that amount of money, she might be taxed at 40%, right? That gives her less money. But by directing that money straight into either a donor advised fund or an IRA or a 401k, she significantly lowered the tax rate that she would have to pay on that money. And she certainly, depending on what vehicle she used, needed to pay taxes on that money in the following tax year, right? When she went to go file her taxes. So, because she could demonstrate that she made that investment into one of these tax advantaged accounts. So, finally, I want to encourage you to consult a financial advisor to optimize your portfolio and your tax efficiency. Your accountant will be able to help you to a certain extent, but a certified financial advisor or certified financial planner, a CFP, like we've talked about, they're going to know the opportunities of investments, right? And unless your accountant really knows more about these investment strategies, I would definitely use your accountant and a financial advisor to help you make some really good decisions on what's the best thing to you for you, knowing what your goals are, knowing what you're trying to accomplish and in what time period you're looking to accomplish those things, because everyone is different. Everyone has different goals. They have different needs. Some people have health needs to consider. Some people have, I've got a friend of mine, his wife is chronically ill. So thinking about the financial maintenance of her healthcare on an ongoing basis is going to be fairly significant. So being able to leverage some of these things to be able to know that you've got these things taken care of are super, super valuable and super, super important. And I hope you don't minimize the opportunities, even if you're right now, maybe you're living paycheck to paycheck. There's no time like the present. At least start thinking about these things. So as your financial mobility changes and shifts, you're ready to leverage these tools as your resources, as your capital, as your discretionary income start to grow. So that wraps up another episode of that wraps up another segment on strategies for tax efficient investing. I know it was confusing. I know it was a lot, but I want you to re-listen to this episode and take down lots of notes. And I really want you to think about this as an opportunity to sit down with somebody. Once again, if you've already started working or visiting or participating in an investment club, talk with other folks. Talk about how do they leverage their tax advantage accounts. But remember, it's not just about how much you make, but it's also about how much you keep and how much might you need to keep for the future, right? Once again, I've used the example of if you're growing a family, you're going to have to, knowing that you're growing a family and whatever that looks like for you, knowing that you have put money away by mitigating your tax expense now and making some investments that will grow, that will allow you to grow your family comfortably. Maybe it's you want to move to another country. Maybe it's you want to move to another state. Maybe it's you want to downsize and want to be able to live in an RV. That's fine. But whatever your plans are, whatever your goals are, maybe it's about sending kids to college. Maybe it's about sending kids to technical school. Whatever those things are, making sure that you are set up for success and you have the tools and the resources by doing that, by looking at how your money is being leveraged and taxed today so that you can leverage what you need to be able to have financial sufficiency in the future. So stay tuned, because in the final segment, we're going to talk into some more higher level advanced strategies and tips for making your investments as tax efficient as possible. And if you're finding these tips helpful, don't forget to subscribe and leave a review and share this episode with your friends. So can't wait to see you in the final segment, where we're going to continue to keep doing different better. Welcome back to the Do Different Better Show. We've been covering some crucial ground on tax efficient investing today. And now we are going to dive into some advanced strategies that can help even more, keep even more of your hard-earned money in your pocket. These tips are for those who want to take their tax strategy to the whole next level. So get ready to take some notes. So let's first start with a strategy that might sound counterintuitive, but it's incredibly powerful. And that is tax loss harvesting. We just talked about that a little bit in the previous episodes. The previous segment. So now I'm going to break it down, because I know when I first heard it, I'm like, say what? I had a friend of mine, she started a business, and she started a financial management firm or investment firm. And she got this investor to invest in the company. And after, I think it was the first year or so, she actually made money in the fund that she had started and managed. And when she went back to the investor to say hey, I made all this money, he was like, I was actually trying to lose money. I didn't want to make any money. And so she was shocked and amazed and surprised, but he was trying to lower his tax liability. So I'm going to talk a little bit about that. So tax loss harvesting is all about making lemons out of lemonade. Here's how it works. If you've got an investment that's lost value, you can sell it to lock in the loss. That loss can then be used to offset any capital gains you have realized from selling other investments at a profit, right? So if your losses exceed your gains, you can even use up to $3,000 of that excess to offset ordinary income. So I know that was a lot of word salad. So here's an example. If you sold stock A at a $10,000 gain this year, but also have stock B, and stock B is down $5,000. By selling stock B, you can use that $5,000 loss to offset half of the gain from stock A, reducing the amount of capital gains tax you owe. So let me go a little bit further. You sold stock A, you gained $10,000 from selling that stock, right? Which means you would pay taxes on $10,000, right? So if you, so where am I going with this? So if you had a tax, if you were in the 40% tax bracket, then you would have to pay $4,000 in taxes, okay? Off of the $10,000. You pay $4,000 in taxes. But if we're using this strategy of tax loss harvesting, like we said, you sold stock B, and it's because stock B is down $5,000. You can take the $10,000 gain, subtract the $5,000 loss. Now you're only going to be taxed on $5,000 instead of $10,000. So that 40% now goes from $4,000 to $2,500, right? So that's how it works. I know, and you're probably still like, it still doesn't make sense to me, Elaine. I know. It's a bowl of spaghetti to wrap your head around, but just kind of just hang in there. Be mindful of the wash sale rule. If you sell a stock at a loss and buy a substantially identical stock within 30 days before or after the trade, the loss is disallowed for tax purposes. Once again, this is something your accountant should be versed in. This is not something necessarily you need to go down the rabbit hole unless you necessarily want to. But the whole idea is that if you're going to harvest a loss, make sure you don't inadvertently buy the same or similar stock too soon. Otherwise, you'll defeat the purpose of the strategy, right? Number two, deferring capital gains. So, another effective strategy in deferring capital gains, which is essentially delaying the sale of an investment to benefit from lower long term capital gains rates. The IRS taxes short term gains, investments held for less than a year, at your ordinary income tax rate, which could be as high as 37%, depending on your tax bracket. But if you hold the investment for over a year, you can typically pay only zero taxes, 15% or 20, depending on your income level. Now, you are taking a risk that maybe the stock goes up even more, and you could take a risk that the stock is going down. These are, these are the conversations you want to have with your wealth manager of like, what's the trend of the stock? Is it trending up? Is it trending down? And what might be the implications? So here's a concrete example. Imagine you bought a stock that's appreciated nicely, but you're approaching the 1 year mark. Instead of selling it now and paying a higher tax rate, consider waiting until you've held the stock for over a year. Maybe it's 12 months in one day or 12 months in a week. This way, you could potentially pay less in taxes when you finally do sell. So here's a tip. If you know you'll need to sell an investment soon, check to see if you're close to reaching the long-term capital gains threshold. Holding on for just a little bit longer could save you some significant amount in taxes. Once again, you might want to keep a calendar. If you're managing your own portfolio right now, you might want to keep a tickler file or use your Google Calendar or use some kind of reminder notice that says, "Hey, remind me in 12 months to look at this stock," or "Remind me in 6 months to look at this part of my portfolio." You can build tickler files, but once again, your wealth advisor or your financial advisor will also be doing this as well. So, but it's always good for you to take ownership in what's going on in your portfolio and not just defer it to your advisor, whether it be a certified financial planner or wealth advisor. Then there is estate planning and gifting, and we did a whole episode on estate planning. So definitely go back and listen to that episode. But let's shift gears a little bit and talk about how tax efficient strategies don't just apply while you're alive, but they can play a critical role in estate planning and wealth transfer. So number one, gifting appreciated assets. Gifting appreciated assets like stocks and real estate to family members who are in lower tax brackets can be a savvy way to reduce the overall tax liability for your family. Here's how it works. If you give an appreciated asset to, say, your child who is a lower tax bracket, a lower tax bracket, when they sell that asset, they will pay less in capital gains than you would have had to pay because they are in a lower tax bracket, right? You may have seen on Instagram, there's been a lot talking about how Ryan Reynolds and Blake Lively, how they incorporate their children into their companies and pay them to offset some of their tax liability, right? But it's also setting their kids up for long-term success. Those kids won't need an inheritance because they've actually started accounts for them and putting them on as employees and making investments into 401ks and things like that for them on their behalf. Those kids will not need an inheritance. They will be fine on their own, but I'm sure Ryan Reynolds and Blake Lively will be giving their children inheritances. Okay. But here's an example. Suppose you bought some stock some years ago and that is significantly appreciated. If you're in the 37% tax bracket and your child is in the 12% tax bracket, gifting them that stock could result in a much lower capital gains taxes when they sell it, which is a win-win. You've lowered your tax burden. Their tax burden is minimized because they're already in a lower tax group. Maybe they'll sell that stock when they're 18, and which means they'll probably be in the lower tax bracket. They're going to pay far less taxes on that. They will have to pay taxes on it, but they'll pay far less taxes on it than if you had paid for the taxes in today and that when you actually gained when the asset appreciated. So it's a win-win. They get the benefit of the asset and the family as a whole pays less in taxes. Your family today pays less in taxes for the next tax year. Be mindful of the annual gift exclusion, which allows you to give up to $16,000 per year as of 2022 per recipient without having to pay gift taxes or file a gift tax return. This makes it easier to transfer the wealth while minimizing tax implications. So, this strategy would be possibly something you use in addition to the gift tax, which you can give a gift to anyone, not just a child. And I believe that would be tax free for both of you. You're mitigating your tax liability, and they can receive that money tax free. Once again, see an accountant. I am not a tax professional. Okay. Two, estate planning. So estate planning is crucial for ensuring your wealth is transferred to your heirs with minimal tax impact. One of the tools here is setting up a trust, and we've talked about that as well, which can really help you control how your assets are distributed after your passing and avoid probate and potentially reduce estate taxes. So for example, a revocable living trust allows you to manage your assets during your lifetime and designate how they'll be distributed upon your death. This can be particularly useful for avoiding lengthy and often costly probate processes, which can eat into the assets that you want to pass on to your heirs. Definitely, I ask you to consider consulting with an estate attorney to explore options like irrevocable trust and charitable remainder trust, which can also offer additional tax benefits. For example, a charitable remainder trust allows you to donate assets to charity, receive a tax deduction, and you'll still get income from the trust during your lifetime. So, all right, let's pull it all together with some practical tips. Some practical steps you can take now to start implementing these strategies. So, action step number one, take a look at your current investment portfolio and see, are there opportunities to harvest losses or defer gains? If you're still feeling funky about this or not sure, once again, this is a great conversation for you to have with an accountant, particularly a certified public accountant. And once again, if you're a small business, you can get access to a certified public accountant through SBA, one of their mentors. So you can have access to these folks for free. There's sometimes meetups. There are sometimes nonprofit organizations that make CPAs available not only to small businesses, but to the general public in particular income brackets. So leverage these resources. Don't think of like, I don't know a CPA. I can't find a CPA. I can't afford a CPA. I can't afford to talk to an accountant. There are folks out there and there are opportunities that are out there. There are even some that are language specific. So I know here in Minnesota, we have some organizations that provide accountant services in Spanish. So don't make the excuse that you don't know. Just start looking. Go put it into Google. Start talking to other folks. If they have a CPA that maybe you can do a consultation with, you might have folks at work that might have a CPA. You might have a CPA on staff, and see if you can just ask them questions, right? Knowing that they are not representing you. And so you want to definitely get your own representation, but they might be able to at least buy them lunch and see if they can offer you some answer some questions for you. But this might involve making some tough decisions, but the tax savings could be well worth it, depending on what your goals are, depending on where you're sitting today, and depending on what are the opportunities that are available to you with the resources that you have. So, number two, if you haven't already started looking into estate planning tools, you know I love estate planning tools that can help you minimize your taxes when transferring wealth to your heirs, whomever they be. They don't necessarily have to be children. It could even be charities. It could be siblings. It could be friends. It could be life partners. So this could be as simple as setting up a trust or gifting appreciated assets to family members in lower tax brackets. So here's my call to action. I can imagine you're feeling overwhelmed. Don't worry. These are very complex strategies and you should seek help. I encourage you to consult with a financial advisor or an estate planning attorney to optimize your tax strategy. And hey, don't forget to subscribe to this podcast where we're going to be talking more, giving you more financial advice. And I am so excited because we've got some exciting stuff coming up. I'm giving you a teaser at some other point in time, but I want you to keep coming back. But definitely share this episode with others, but definitely start talking with others. You don't have to go on this journey alone. I definitely encourage you, if you're doing it as a family, involve your family to start talking about this. Maybe it's Sunday morning breakfast. You talk about, well, everybody's responsible for learning one thing, and everybody comes to the table on Sunday morning breakfast and talks about what they learned that week. And you guys are going to be, you're now normalizing having conversations about money. You're normalizing having conversations about investment, and you're normalizing that you don't know what you don't know, and that's okay, right? So I hope you have found all of this and the tips that I provided helpful, and that you are now ready to take action. Remember, smart investing isn't just about making money, it's about keeping it too. So let's keep doing different better, and let's keep it going. So, that, we did a really deep dive into advanced tax efficient strategies today. I covered what tax efficient investing really means and why it's crucial for both individuals and small businesses. I shared some really powerful strategies like using tax advantaged accounts like 401ks and Roth IRAs. Also, why investing in index funds and ETFs could save you big bucks in the long run. Plus, we dove into advanced strategies like tax loss harvesting and estate planning that could take your tax savings to the next level. I hope you gained some valuable insights on how to leverage your investments to your benefit, and I hope that you're feeling more confident. Don't forget to subscribe and leave a review, but join me in my next episode next week. I'll be diving into the deep end of money fears and showing you how to come out stronger on the other side. We're going to talk about why money anxiety happens, how it messes with your mind, and most importantly, what you can do about it. We also have some special guests. We also have some special guests coming up. And I can't wait for you to meet them. So stay tuned. Let me know what you think of the show. We love comments. Tell us how this show has helped you, and if you have a money or finance question you have. If there's somebody you want me to interview, hit me up on LinkedIn or Instagram, and don't forget to hit the subscribe button and follow us on socials. Can't wait to see you next time, where I show you how to do different better.